Welcome back. Axis Bank shares are trading at all-time highs, of course. Sensex Nifty and the Nifty Bank are also trading at all-time highs. Axis Bank posted perhaps the fastest loan growth compared to the top three private banks at 11.7% in the second quarter. There was a very good margin management as well. While many brokerages, Jefferies, Nomura, HSBC, have all a buy rating on the stock due to the better valuation, analysts are worried about the repeated one-offs that have hit the P&L and, of course, more lately, some high-level resignations. To get an idea about the bank and how it sees the coming year, that is 2026, I have with me Amitabh Chaudhry, Managing Director and CEO of Axis Bank. Amitabh, good morning. Thank you very much indeed for your time. You're the first big banker we are speaking after the festive season. So how was it? How was the loan demand? And would you want to substantially increase your loan growth guidance?
So, Latha, thanks a lot for calling me on your show. Let me start answering your question. Loan growth during the festive period reflected strong customer sentiment and structural enablers. So just to give you a sense, on the Wheels business, we achieved a strong growth in October 25 versus 24 of 21%. And obviously, this was driven partly by the pent-up demand of September flowing into October and some of the GST rate cuts, which you saw, obviously the buoyant festive sentiment and positive customer confidence stemming from all the actions which the government is taking, and so is the regulator. And we saw some similar trends on the mortgage side. Even on the card spends, we got an extra boost with GST benefits coming in right at the start of the season. So we saw strong demand and double-digit growth across key categories such as durables, shopping, and online marketplace sales. For example, in card side, we had partnered with almost 200 brands during the festive season. So overall, the sentiment was positive. November, the trend is looking decently good. I wouldn't say obviously it will not be a repeat of the festive season, but overall, the market sentiment seems to be strong. You're also seeing clear upgrades coming through on the expected GDP growth rates. So I think that is also getting reflected in real projections on how the economy is expected to do. Obviously, I mean, there are always challenges, but overall, the sentiment does remain strong.
So you would want to give us a guidance?
Okay, sorry about that. Well, we are progressing well to be a stronger and sustainable franchise. We've been talking about that theme for quite some time. We do believe our platform will allow us to grow at rates faster this year than the industry. And this thesis, we believe, will continue to play in the medium term. The supportive regulatory conditions and the operative landscape obviously adds to our confidence. We have also said that in the medium term, which is defined as 3 to 5 years, we believe our advances growth will be above the industry growth rate. So, yes, obviously, the credit growth rate is picking up. The numbers seem to indicate that. The deposit growth rate seems to be a bit tepid. But our view is that given the pipeline we have, given the momentum which we are seeing, this year we should be able to maintain a growth rate higher than the industry. And then obviously, in the medium term, we also expect to continue to drive our platform accordingly.
Okay, time permitting, I will come back to this. The more recent news that hit the exchanges was the resignation of the chief risk officer. Now, actually, I went back. For the past year, you've had not just Amit Talgeri, which is the most recent risk officer, Arjun Chaudhry, the affluent banking and cards guy, resigned, S. Bhaskar, the chief of audit, Ganesh Shankaran, the wholesale banking. That was 1 year ago in November. So, I mean, is there a pattern we have to read, or were these all personal decisions?
Oh, well, there is no pattern here in the sense that, firstly, recognize Axis Bank as a great platform where we are generating talent which people want to hire. In some cases, the decisions have been personal. People have been doing the same job for a long period of time and they want to take a break. And so in some cases, some of the names that you took, people actually have picked up jobs post leaving us, which are more slightly less intensive in nature than what they were doing earlier. So it's not leaving the organization, it's making a lifestyle choice. In some cases, they've got opportunities which are very, very different from what they were doing in Axis. I mean, you took one name where the person has gone and is running a very small company, but the potential to grow it larger is huge. Okay. This is kind of a completely different platform. So I think the reasons are individual. Okay. I don't think it reflects anything on Axis, but I'm quite glad that people are now seeing Axis as a place where they can hire extremely good talent.
Oh, yes,
and
yes.
We have replaced Amit with someone internally. So we have enough talent internally also where people are getting opportunities to grow.
Okay. No, if that's the reason, that's very good. I just noticed the pattern. Let me come to the other news which CNBC TV18 broke. My colleague Yash Jain, broke a story on the Insurance Amendment Act that's going to be tabled on Parliament. And there is a major liberalization in the sense insurance companies may be allowed to merge with non-insurance companies. Now, you have, of course, Axis Max and Max Financial. Do you think, therefore, a merger is imminent? If this is
This
allowed.
has been on the cards for a long period of time, Latha. I mean, we have been hoping that the new insurance bill will allow merger of these entities. The core business will obviously remain insurance, and that's the only business they will do. Here we have a unique case where there is a holding company which holds shares in a insurance company, and so that's the only thing they hold. And we would like to have a merger so that the shareholders of that holding company can take ownership of the Axis Max Life Insurance directly. Recently, you would have also been aware, when the story was broken, that IRDA has decided not to pursue the case in Supreme Court. So it's an indication from IRDA that maybe the bill is coming or they will allow something like this to happen. Our views are that there is further guidance expected from IRDA on this matter. And based on that guidance, we will act. Our intention and hope is that we will be allowed to merge the two entities so that there's only one entity which is out there. By the way, Axis Max Life is doing exceedingly well. And I think that is also reflected in the stock price and their market share gain. So we're very delighted with the investment we have made and how that entity is progressing.
Okay. You all had also expressed a desire to increase your stake in Max Life, that is Axis Bank's stake. But there was the SEBI investigation on the pricing. Anything latest from SEBI? And therefore, if that is a done deal, can you go ahead and raise your stake?
Well, the investigation from SEBI side is going on. Normally, these investigations and this process takes time. So we are going through the process. We believe that we have a very strong case here. That I think whatever we have done is with the full approval of the regulators involved. But obviously, SEBI as a regulator has the right to go deep into the case and take their view on whether what we did was correct or not. And we are going through that process. Okay. We would obviously like us to take our stake to 20%. We would also like to, understand once the Forms of Business circular comes as to what some of our options are. Right now, we don't know. Yeah. And at the right stage, we will see whether we want to increase our stake or not. We cannot take that decision unilaterally. There are other shareholders involved. So it will take time. Right now, there's nothing on the card.
Fair enough. Anyway, regulators seem to be in a more liberalizing mode. So let's see. Let me now come back to your P&L. Margins, it was a pleasant posting that you all did, just 7 basis lower NIMs. What is your sense about, will Q3 be the bottom? I think that's what you guided, that Q3 will be the worst. And there is a possibility of another rate cut. So then what happens to the NIMs?
So let me start by saying, assuming there is no further rate cut, let me give that position first. We expect margins to bottom out in Q3, mainly due to a slight, and the reason why margins might go down in Q3 is because of a slight tilt of loan mix towards wholesale over the last few quarters. Okay. And obviously, we'll see the agri seasonality impact in Q3. A bank has maintained that through life cycle, the cycle stance of average NIMs at 3.8%. And cycle is measured in terms of duration of 15 to 18 months, starting from the date of last rate cut in June 2025. So we are maintaining that stance. We do believe that the margin trajectory is like an inverted C. Effectively, margins will moderate when the rate cuts are announced, drop on the inverted C, and then it starts climbing back towards the end of the duration period, because then the kind of deposit rates also catch up. We all know that the expectations in the market on the rate cut are quite high. I think people are almost assuming that the rate cut is pretty much a given because inflation projections are low. And that obviously the impact of GST cuts is flowing through. So my view is that a rate cut might happen. So some of the commentary which we have given in the second quarter might change. But the overall, if you kind of expand the time period, overall our commentary on margins does not change. Quarter to quarter, it might be different because there is a additional rate cut that might come in.
Okay, fair enough. Now let me come to credit cost. Both credit cost and slippages as ratios fell, and that was positive. But you all have not gone back to your Q4 lows. Last year, Q4, your credit cost was 50 bips. Now you are 73. What should be the direction of slippages and credit cost? Can it go further lower?
We do not provide any guidance on the credit cost.
You didn't.
But financial 27, we do believe would be normalized with effect in comparison to financial year 26. Okay. So we have had some one-off events. Firstly, they will get normalized. Secondly, Credit cost cycle itself is witnessing a normalization from through cycle trough seen in financial 23 and 24. So despite this normalization process, so for 23, 24 were way lower than where they should be. Then we saw obviously a spike. Now we are kind of coming down to normalized levels, which will be slightly higher than financial year 23-4. Okay. But our view is that they will settle at levels lower than what we are seeing right now. And obviously, Axis Bank has been quite conservative in terms of the approach it has taken to the kind of the risks which you want to take in the business, both on the wholesale and the retail side. And our view is that this will continue. So overall, things are stabilizing, and they should stabilize at levels lower than where they're seeing.
Okay, I have just one more question on that, but let me, get out of the way a worry which analysts have. While you are a buy, the stock is a buy for many of the brokerages. There's just this worry. Twice in a row, you had a one-off. Yep. So, and then on October 9, there was another caution from RBI. So, should we expect another one-off, or is it over and done?
See, some of the one-offs which are there were subject and based on continuous evaluation of our policies, products, services. In some cases, we discovered them ourselves. In some cases, we were guided by RBI. Right now, we are not aware of anything which would result in a one-off. But, I cannot guarantee that this will not happen. Yes, we have taken that one-off, and the last one-off which we took, we have very clearly stated to the market that we expect this amount to be written off or written back completely in the March 28 quarter. It just gives us increased provisions in what we had earlier. We always had the COVID provisions which we have not touched. So we do believe we are a conservative institution, as and when we discover something where our standards or our accounting policies are slightly below what a typical conservative institution would have, we will step up very, very quickly and take whatever hits we have to take. We are not aware of anything right now, but the interpretations do change. Sometimes you do see things where maybe you could have done it in a slightly different way. That keeps happening, but hopefully the size of the balance sheet we have should be able to absorb them without too much of a problem.
Fair point. No, of course, it didn't impact margins, etc. Just now coming back to that slippages part, most of the banks, including yours, were lending a lot of loans to MSMEs. Now, do you see any danger at all? I mean, for other banks, they went even 29, 28% higher on MSME loans. In your case, I think it was 16% higher year on year. You don't see any danger over there, is there, MSMEs?
Well, as you rightly pointed out, there is an increasing commentary coming from NBFCs that MSME side of the business is seeing trends which are negative. And right now, let me just clarify once again, we have not seen any signs in our portfolios, although we continue to keep a close watch. The fact that it is happening somewhere in the industry and we are in the risk-taking business, we should obviously, be reading this commentary very, very seriously. Just to clarify why we might be different, significant portion of our MSME book is secured by way of immovable property or assets. So it adds comfort not only to the underwriting toolkit, but also recovery in case of stress. Just to give another data point, 85% of our portfolio and 87% of our incremental sourcing is from SMA 3 and above borrowers, which is obviously higher rated borrowers. So these rating scales are back tested and monitored with rigor periodically. And as on today, they demonstrate performance above acceptable levels on various parameters. Another data point, 70% of our loans are short tenured. Hence, reducing exposure to default is easier, or you can monitor them faster and lower than the long tenure loans. We also quite well diversified geographically and industry-wise. So there are things which tell us that, okay, we might be slightly better placed, but I do not want to kind of walk away from the fact that the industry is feeling some stress and we should be watching our portfolio like a hawk. And that's exactly what we are doing. By the way, the recent announcement from the government on the relief package, which is similar to the earlier ECLGS scheme, will also give some breathing room to some of the SMEs who might be suffering. So watchful, right now seeing no signs, but being extremely watchful about this portfolio. Oh,
thank you very much, Amitabh, for a many-sided interview. I could have gone on, but out of time, and the stock continues to trade at all-time highs. Thanks a lot.
Thank you. Thank you so much, Latha. Thank you.
Okay. Well, there you are. All indexes at all-time highs. Sensex, Nifty and Nifty Bank, and the stock we just spoke about, Axis. On that positive note, wrap up on Bazaar Chartbusters coming up.